It means that they are looking for any and all reasons to say this is a solved problem, move on, nothing to see here.
Hey guys, welcome back to Library of Wealth. Today we have billionaire investor Chamath on the All In podcast, giving us his take on what the current market sentiments are and what we can expect in the next few months. Chamath has seen that retail and hedge funds are the two main pockets where flows come into the stock market, with retail at the moment being where all the flows are concentrated, while hedge funds are sitting on the sidelines, recovering and waiting, as they do not see anything compelling to buy. He also noticed that the feeling of tension in the stock market is the psychological desires of the people involved to have the current inflationary risk behind them. Let's check out this interview with Chamath as he gives us an update on economic and recession indicators that many investors are starting to see now. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
But if you look again today, and what I mean by like the market has roughly shaken this off, like the fact that the markets right now as we talk are essentially down half a point. The S&P is down, 12 points. It means that they are looking for any and all reasons to say this is a solved problem, move on, nothing to see here. Now, that is a psychological reaction. Most of that, if you actually, I called a friend today and I said, where are the flows? And he said, retail right now is where all the flows are, meaning it's retail that's buying. They're in the 30th, 35th percentile of where they normally buy, which is a pretty healthy signal. The way the market works basically is you have buyers and sellers. And, to make it really, really simple, you have hedge funds as one class of buyer.
Sure.
You have ETFs, but they're not really because they have
funds,
yeah, but they have fixed strategies. And so, they're hedging, they're moving, but whatever. And then you have retail. Okay. So it's retail and hedge funds. Those are the two main pockets of where the flows come into the stock market from. And you can get a real sense of what's happening, what the psychology of the market is, if you see what those flows are. And right now, what we see is that hedge funds are largely on the sidelines. What that means is they've been so battered and bruised. In some ways, I think they're licking their wounds, but they're mostly waiting. They do not find a compelling reason to buy. Their business is to make money relative to their index. And so if their index gets torched, them doing nothing makes them look like geniuses. So they don't necessarily have to buy at any point. They just need to make money in the end. So right now we're in a situation where the markets are looking for a direction. Retail seems to think that direction should be up. Hedge funds don't have an opinion, are saying, we're just going to wait this thing out.
Okay.
Meanwhile, the data, at best, is a question mark. And I think that's the tension we have right now in the stock market is the psychological desire is for this thing to be over. Meaning, I think people want to hear inflation is done. We're starting the recession. Give us 3 or 4 quarters. We'll be out. Here's a steady state interest rate. Let's go tech.
Chamath notes that it takes diligence to be able to understand all facets of a business, and to have a good judgment of what is and isn't possible is a crucial element. Chamath has been underwriting, trying to see how value-added services work, what types of margins can be sustained, and how banks can generate a net increased income, and theorize on how take rates will evolve.
It really depends on the sector. So, for example, when I was trying to underwrite Open Door, what I really wanted to understand was, what do take rates look like in all these various markets? Well, how do I think take rates will evolve here? How do value-added services work? What kind of margins can you sustain? What is the sensitivity of different parts of the real estate economy to interest rates? That's an example of work. When I was underwriting SoFi, what you're trying to understand is, how do banks generate net interest income, NIM? How does that change over time? How does bank charters change that? How do loss rates change in times of economic expansion versus recessions? How do you price all of that into a fair value of a business? It's just a lot of really detailed diligence to understand all the facets, or as many of the facets as possible, of a business that allow you to have a clear-eyed sense of what's possible. Then there are others which are pure technology bets, where you try to understand either the biology or the technology. We talked about that this was going to be a big print, right? I think we all expected this to be a big print. I actually also kind of put myself on a limb there, and I said, I wouldn't be surprised if at some point we print a mid to high nines, maybe even a 10 handle at some point.
We're getting there.
And the reason is because, rents are a little, they lag in how they're reported inside of CPI. So we have a couple more months to go of rents, and rents aren't moving or budging a bit. That's number one. We do see a little bit of fall off in energy prices, but I'm not so sure that it's enough, frankly, to move the needle. So I think that we could be in a sustained period for a while. The more interesting thing I thought today was that Canada surprised everybody and raised their benchmark interest rate by 100 basis points.
Okay.
So and they just came one full point, 100 bips, and they just said, we're going for it. We need to tame this. We need to break the back of inflation.
They ripped the Band-Aid off. Yep.
Yeah. And, and I think if you read the Fed minutes more carefully, I think Jerome Powell is basically ready to do the same thing.
Yep.
After this inflation print, the expectation for July went to 80 basis points from 75, which means a small percentage of people actually think it's going to be 100. And September, I think, moved to 75. So the question is that enough? I just don't know. I'm worried that we're in a sustained inflationary environment. I'm worried about that. I hope that we're not. But then the question, Jason, secondarily is then what do the markets do? And what's so interesting today is like the markets shook it all off. I mean, like you could not have had a worse inflation print. Everything was up.
Well, 10.
meaning like it was beyond the number that was expected. Every component of it was up. Everything looked horrible. And people were like, meh.
Is that because the market is future looking, Sachs?
Yeah,
the market is basically pricing, we'll get through this in 6 to 12 months. Is that what you're saying, Sachs?
The markets are down right now, to be clear. The print was definitely worse than expected. They were expecting 8.8%. It was 9.1. Last month's number was 8.6. I remember us talking about inflation a couple of months ago, saying that we thought it had peaked, maybe in April or May at the latest, simply because inflation is measured on a year-over-year basis. And we were starting to lap much bigger comps last year. Remember this conversation?
Yes.
Well, the lapping effect turned out not to be enough, and inflation is still rising. So we have not yet peaked on CPI. I understand that core we have peaked, but deciding to exclude energy and food, I mean, that's a pretty arbitrary decision. Those are two really important variables that matter to the ordinary American for sure. So we still have this problem, and to Chamath's point, we don't know when it's going to subside. And I think the big question now is, when does inflation finally peak and start going down back to where it should be? And then how severe a recession do we have to have in order for the Fed to solve this problem?
We've seen of late that Canada has surprisingly raised their benchmark interest rate by 100 basis points to try and put a stop to inflation. Chamath has observed, amongst other things, that Jerome Powell seems ready to rip the bandage off and do the same. He's seen that the markets have been going down much further and worse than he had expected, and that much bigger comps were starting to be lapped last year. But even the lapping effect is not enough to stop the surge of inflation. What do you guys think about Chamath's market outlook for the rest of the year? Let us know in the comments below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.